Hello everybody, welcome to TraderMerlin Show. It is your Wednesday edition, hump day it is. And you know, right as you make it over the hump, that's usually when things start to go down aggressively. And I guess you could say, going right into the close, we were still moving to the upside. Then all of a sudden, bada boom, bada bang, we had a nice sell-off near the end of the day, which certainly helped my IWM puts. Hello, Brendan, Big Eb, Terry, Tom, Raj, Lori. We got a big group with us. Jorge as well. Thomasina, good to see everybody. I received this question, and I'll start with the question, and then I'll go to what the show is going to be about. The question was from Clint. He said, I struggle with strategies to use when trading options, any pointers? And I thought, you know what? I do have a little bit of options experience. I am by no means an expert. You guys know that. I don't claim to be. But I do have somebody who is an expert in the options world who comes on the show rather regularly, and that would be none other than Mr. Corey Lane, talking about choosing your option strategy. Corey, how you doing today, my friend?
What's up, party people? How you doing, Merlin?
Wonderful. It's funny. I do great when the markets are down, and when the markets are up, it's usually like, it was okay. But down days, loving it today.
Love those down days. What are you, a perma bear or something?
No, I'm a perma bear. It's just I think that there's so much aggressive move to the south side. Like, it seems like when things go down, they really go down quickly. And today's good evidence of that. The last hour and a half of the market was like, holy cow, here we go. But yeah, I like to do what most people don't do, and most people don't short. So I'm going to be the short guy.
Good call.
Not to do with my vertical height or anything like that. Yeah, no, we're good.
There you go.
All right, Corey, how you been over there at Traders Army?
Man, we've been awesome, man. It's been, obviously, the market's up and down, and it's kind of going nowhere, really, for the last several weeks, it seems like. So from a directional trading standpoint, there's been some really short-term opportunities that are great, but ultimately the options are where I've seen some of the better trades come along. So, yeah, doing awesome, man.
Cool, good to hear. All right, let's go to Clint's question, which is about different strategies. And I think in the materials I wrote for Twitter and Facebook, it's easy to pick a strategy when you're trading stocks or futures or Forex because it's binary. It's going to go up or it's going to go down. Sure. The challenge here, I think, is the complexity of options, and there is such a plethora of things to choose from when picking an option strategy. Any pointers you have or suggestions for Clint that may help out there?
Oh, absolutely. I mean, this is actually one of my favorite subjects around options. Obviously we can get really down and dirty and get into volatility and option Greeks and all that super fun stuff, but strategy selection, I absolutely love. And for me, it's quite simple. And I think that's the key that I want everybody to kind of think about when selecting an option strategy, is that there are literally more option strategies that people have created out there, with some of the funkiest names too, right, Merlin? The iron butterflies and diagonalized butterflies and diagonalized upside down elephant ear condor. There's all kinds of different option strategies. Most of them are in some way, shape, or form trying to compensate for one's inability to actually pick a freaking direction, right? And so they create these complex strategies, which just overwhelms the user. It's like, when do I use that one? When do I use that one? So I prefer a handful of trades specifically related to, even more so than just buying calls and puts. I'm a huge fan of spread trades. Huge fan of spread trades. And one way that I choose which trade to use, which type of spread trade to use, is we look at volatility, which is implied volatility, and say, where are options pricing today? Are they low, high, or kind of in the middle? And then the second thing I look at really, and this is it, is what is my overall directional bias? If I have a strong directional bias, I'll choose a directionally biased option trade. If I have a so-so directional bias, then I'll choose more of a credit type position where I can be directionally wrong and yet still make money. So I have some examples from time to time that I'll pull out, and people say, well, what if I choose a long call, or what if I choose a bull call spread? What's different between selling puts and selling a put spread? But really, I use about 5 different strategies on a regular basis, and that's it. So that's number one. Just keep it simple. Only choose 3 to 5 strategies, and you should be good.
I keep it down to just a couple. I'm not really even a spread guy. I'll say, and I'm watching the comments that come through here. Brendan says, my next options account, I'm literally only doing cash-covered puts, put writing, nothing else. Yeah, and I have one account that I can only buy puts, buy calls, sell puts, sell calls, all would be cash secured, and I actually wouldn't even sell calls unless it was a covered call, but so really 3 unless I have an open position there, and that account is only 4 options. And I think that it might help for some people to put restrictions on what you can and can't do in specific accounts. Now, if I was going to maybe advance my understanding of options and get into, strangles and straddles and iron condors and all that stuff, then I would probably have a different account for those. But I specifically wrote those rules because I don't go out of my comfort zone. I'm very comfortable with those strategies, and therefore I don't break any of those rules. How you mentioned when you're looking at spreads, which maybe we could talk a little bit about what the mechanics of a spread is, volatility and overall direction. So obviously there's going to be parameters there with regards to volatility in a market where there's very low volatility, very high. What type of breakdown do you have there with regards to choosing strategies based off volatility?
Can I share a screen?
You can always share a screen
with the group, buddy, because sometimes it's easier to just kind of visually point it out. So let me see what screen I want to share here. There we go. You can see my Thinkorswim, right?
Yep, got it now.
All right. So first and foremost, let me see. What was I looking at today? I was actually looking at this on Tuesday. Walgreens taking a beating thanks to Amazon news, right? Mm-hmm. But I love it because the Walgreens, trend has been down for such a long time, and now we're starting to put in, some bullish momentum down here and higher highs, and I'm just hoping right around this 36, 37 and a half area we get a little bounce and it'll put in a nice little lower low. But the first thing that I look at when it comes to choosing an options trade, and this is something that that I've been using since day one, but it's just kind of modified this indicator, which is just you pull up implied volatility in any trading platform, implied volatility, and that's going to give you real time. Most platforms will give it to you in real time. Some of it's a day delayed, but it's a real time indication of how inexpensive or expensive options are. And this comes from the overall supply and demand of those options. So the greater the demand for options, whether it's calls or puts or both, you're going to see this black line here be higher on the overall scale because options are just more expensive. Naturally, when you think about if something is overpriced or more expensive, what should we be doing with it? We should be selling that product, not buying that product.
Right.
So that's the first thing. If something is high in price, we're going to sell that product, not buy it. If something is low in price, say down here in the lower 20%, I'm just using this chart down here as kind of like the way we would use any price chart. And these are option price charts down here. And so if prices are very low, for me, for instance, in the lower 20% of the last 1 year range, that's a relatively cheap, option series. And so anything that's relatively cheap or undervalued, we want to buy those. It's when you get in this middle white space here, Merlin, between the upper, more expensive range for option pricing and lower, more cheap range. It's when you get right in this middle white range, which is our middle 60%. That's where a lot of spread trading for me has to occur. Reason being, if you buy an overpriced option and vol drops, you're going to get some losses stacking up just on the fact that volatility drops.
Even though you may be right on the direction.
Even though you might be right on direction, the price of the stock may go in your direction, but if volatility goes against you and time decay is going against you, you got 2 out of 3 things that are working against you. It's going to hurt your position, and it's going to be, the stock price movement may be meaningless to the overall net profitability.
Right.
So the idea is to put as many of these factors in our favor: direction, time, and volatility. Well, directionally speaking, you use the price chart above to determine whether or not you're bullish or bearish. The chart down below is option prices on that stock, and we use the same methodology. If prices are cheap, we're expecting a bullish outlook on volatility. We want to buy that volatility. If prices are high, we want to sell that volatility. And if prices are in the middle, we want to negate it as much as possible by both buying an option and selling an option on the same stock at the same time, which creates the spread trade.
Right.
And that is the primary purpose for a spread trade, is to reduce exposure to unwanted time decay and volatility and just overall movement. And I think that's a critical point to make is, when choosing an option strategy, you have to figure out first and foremost, what do you want exposure to? And then what do you not want exposure to?
Right.
You know what I mean?
Yeah, I do. And I like it because it feels like you've simplified the decision process down to I guess I'm going to say the chart, but I mean, ultimately, when I look at your implied volatility at the bottom, you're basically saying, is it a point now where I'm looking at potentially buying those options because they're cheap, or am I looking at selling options because they're expensive, or if it's in the middle of no man's land, then I might go and look at a spread strategy accordingly, right? Could be debit or credit spread, depends on which one you want to do.
Yeah.
So you've now kind of broken down the selection process into 3 bulk choices, and of course, when it's down there and options are inexpensive, there's strategies we can use based off that as well. It doesn't just necessarily have to mean that we're just buying directionally. There could also be some strategies involved, but I think you've simplified the process of indecision by just looking at that IV gauge.
Exactly, and it's my goal to simplify not even my own trading, but also trading for the members at Traders Army and anybody that I happen to coach or mentor along the way. There's so many things that we could be making decisions on that make people so confused and paralyzed from the lack of knowing how to make the decision. Mm-hmm. So simplifying it is critical to me.
Well, I want to dive deeper into this. I have a question that came in from Brendan, which is a good one. And Brendan says, any suggestions for accounts without clearance to sell, right? I think actually level 1 is selling, but that would be covered positions. But
covered, yeah.
But as you get to like level 2, where it's saying, okay, I can buy directional, I can buy a put, I can buy a call. Any suggestions for people that maybe can't get up to or don't have the higher levels of clearance in their account?
Well, first thing, if you don't have clearance it's not difficult to get that clearance within the account to trade higher level option strategies, and you don't have to go all the way up to the highest level of authority.
Right.
And each broker is a little bit different on what strategies they actually put in each level of authority. Like TD Ameritrade for Thinkorswim, they only have they don't have 5 levels. They have 2 or 3 levels. They have their advanced tier, which lets you do pretty much anything. I think TradeStation has all 5 levels. Interactive Brokers, I don't think, has any levels. You just open an account with your 10 grand and fund it, and it's like they'll let you do whatever the hell you want, which is great
Nice.
for the user, but could also be very dangerous for the user if they have no idea what they're doing, right? So first and foremost, it's not difficult to get a level of increased authority. The trick, I think, is you have to have some experience in the background, or wink, wink, say you have some experience in the background.
I've never done that. No, come on.
Who would ever do that? Because I can tell you when they ask you, how many years options experience do you have? And if you put 0, which might be the truth, then they're not going to be so willing to give you higher level of authority, because you have the ability to ruin your own financial situation very quickly. In addition, start dipping into the broker's financial situation. So I can only talk about what I did when I first started trading options about, almost 16 years ago. And I opened my first account with a company called Options Express, which was later bought out by Charles Schwab. And when they asked me the question on the form, how many years experience do you have? I mean, technically I had no years experience, but I had a lot of hands-on trading that we did in our live classrooms. And so I figured that's got to count for something.
Yeah, of course.
And so I picked the lowest number. I think it was 1 to 3 years experience. I just picked the lowest, and I'm like, well, I'm not going to go say I have 15 years experience, because I only had a classroom experience. So I picked the lowest, and I was very quickly able to get right up to level 4 out of 5.
Yeah.
Just because I had that little bit of experience.
It doesn't take much.
Doesn't take much. Some brokers actually want you to have a minimum account value. So I ran into a student, one of our members at Traders Army the other day, who tried to get a higher level of authority, and I think they only had $2,000 in the options account, which you can open an options account for, but they weren't willing to give above a level 2 authority. So basically buying calls and puts and selling cash secured stuff.
Yeah.
So I would say check other brokers if you're having a difficult time with your own broker. See what it looks like to check with other brokers and see if they'll let you get higher authority. If it's a funding thing and you need more money, then people have their own way of finding more money and putting it in the account to fund it. You know what I mean?
Yeah. There's always a way. I mean, you could even go prop shops, but I don't usually recommend prop shops.
Even if temporarily fund it just to get the authority, and then remove the money. You need to put it back where it came from.
Right. Yeah. Yazad asked what broker are you talking about? The interactive brokers is when we're talking about there.
Interactive brokers, yeah. From what, like, when I opened my account, they never asked me anything about options, and so I don't think they have levels of authority. I think they're just, you want to do what you want, then just fund it with the minimum requirements, and you can do whatever you want. Right?
Yep.
Yeah.
Go ahead.
I wasn't saying it.
Oh, I thought you did. Okay. Raj says, let's see. Raj says, are spreads better than cash secured puts and covered calls?
Depends upon the spread. But if you're referring to a credit spread, let's assume that he's referring to, say, a bull put credit spread or a bear call credit spread. Again, depending upon your motivation, the short answer, right off the top of my head, absolutely. I love spread trades over anything that ties up as much capital as a covered call or a cash secured put. From a use of capital standpoint, covered calls and cash secured puts take up a lot of capital.
Because you're holding the underlier.
Yeah, because you have to hold the underlier, or you have to have the cash to purchase the underlier when selling a put.
Yep.
One thing, because I'm reading the chat here, one thing that Brendan also said as well is, Interactive Brokers has customer service that's horrible. I would agree with you.
I'd second that. I'd third that one, yeah.
I would third that one. I can't tell you how many times I called them. And one guy I was talking to was telling me, well, this is how it was when I was on the floor and I came from the pit. And I'm like, and now what are you doing? Answering the phones?
Yeah.
With me?
You fall from grace there, buddy.
Yeah, easy, buddy. He said, Brendan says, cash covered puts, if done correctly on the right stocks at the right time, are arguably the safest option strategy. They are, from an option standpoint, sure, but the catastrophic risk associated with a news-driven event around a stock, because you have cash tied up to buy that stock, you effectively have a cost basis that is right at that strike price. Mm-hmm. So I've had a number of people think that, this is a very safe strategy. I'm going to own the stock at a discounted price because I own the stock at the strike price when selling cash secured puts. But then the stock goes down so doggone much that it turns their position into a massive loser. And all of a sudden they're like, well, I wanted the stock at 80. Now that it's at 30, this sucks.
Right.
Do you know what I mean?
Yep.
So it does carry a lot of overall underlying risk. So anytime you use a credit spread instead of just cash secured or covered calls, it's way less risk, and not even arguably, it's absolutely a better return on investment because you have a much lower capital requirement when dealing in a credit spread versus a cash secured put.
Right.
So I personally don't like the idea of selling cash secured puts all by themselves. I prefer to sell that put where I want to own the stock, but then buy one, even if it's way out of the money, buy one that ties up less capital, protects against catastrophic risk, which again turns into a spread trade.
Right. Yeah, it's interesting. I don't do spreads, and I probably should. Most of mine is cash secured stuff, and I actually like it. I mean, I think that's the main reason is I know that I'm going to get a specified rate of return on this one, barring some catastrophic event, and that's usually not going to happen. But, by doing the spreads, which just adds a level of complexity, because now you're doing two option trades for the same specific trade, it was just confusing for me, and I think that at some point in time I'll probably be more inclined to do it. But I have that old adage, if it ain't broke, don't fix it, and the rate of return I'm getting for just doing cash secured stuff has been fine for me. So
great, yeah.
Yeah.
Well, when you're ready to learn, Merlin,
come on over.
Let's do this thing, man. You know a lot more than you probably even, because you're a super humble dude anyway. So when you say, I don't really know about that stuff, I'm betting you probably do.
Yeah, I do. It just, it's funny because when someone, you explain things to somebody and they go, well, you don't trade this, you must not know. It's like, guys, I trade almost everything, and I'm looking at every single market. Not only am I trading off it, but I'm analyzing all these different markets. So, I mean, there's only so many hours in a day. When you're trading futures, you're trading Forex, you're trading equities, and you're trading options in, 8+ accounts, it gets a little hairy sometimes. So
just a tad bit.
Just a tad.
Just a tad.
All right.
But so I kind of look at spread trading, especially on credit spreads, because you were talking about selling cash secured, and that works really well for a specified rate of return.
Yep.
I kind of look at it as my insurance company, sells me a policy, and I know that they take some of my premium and reinsure against all the risk, or a majority of the risk. And I kind of take a page out of that book because it's an extremely successful business model to be an insurance company and sell policies that are expected to expire worthless, 6 months to a year from now. We just take that same methodology and say, I'm going to sell somebody a policy or an option for a week or 2 or 3, maybe 4 weeks tops that'll expire.
Yeah.
I expect it to expire worthless, but hell, if I'm going to actually take delivery of a stock at $100 a share when I have clear room to fall to 0, why wouldn't I just buy an option and use that option strictly as insurance? That's it.
Right.
It's a reinsurance policy, which actually increases your rate of return. So if anybody cares about increasing their rate of return on their short options, spread trading is where it's at.
All right. Well, it's on the next one on my list. Maybe it'll be my holiday, my Thanksgiving study will be on spreads. Walk me through something you mentioned earlier. You talked about some of the margin requirements, and going back to Raj's question about which one was better, doing covered calls or using spreads. You mentioned that the margin requirements were significantly different. I think that might be good to illustrate that one because, in a situation like mine, I am tying up a tremendous amount of capital, whereas I might be able to put more capital to use with the spreads because of those margin requirements and the cost. Do you want to explain a little bit why the spreads are cheaper?
Yeah, I can absolutely do that. I was going to maybe try to draw something out. I don't know if you guys will be able to see this, but if I draw this out in a blue color, can you guys see that?
Yep.
Merlin?
Yep.
Yes?
Got it.
Man, that is awesome. All right, so let's take let's maybe take I don't know, it could be any stock. Let's take Apple. Everybody loves Apple.
I hate Apple, but it's okay. We can do the example.
Okay, let's use Tesla.
We actually had a question about Tesla earlier. What was that question?
Yeah?
Tesla? Yeah, someone was asking about Tesla earlier. Let me just scroll back up here while we get ready for this one. Merlin, Big Ed says, Merlin, to further the Tesla talk yesterday, it might be a short if it crosses 500-ish. Okay, well, that might actually help set this trade up. It might.
Because, right now I don't have a position on Tesla. And so my first, inclination with as far as how Tesla's been, generally sideways, which is fine. I like selling options in a sideways market. I'm going to use this as an example because it's an awfully expensive stock relative to what most people would think they would want to go out and buy 100 shares of, right?
Mm-hmm. Yep.
So first and foremost, if you're buying 100 shares of Tesla to write a covered call against it at some point in the future, you're going to have to put up $48,000 to buy 100 shares of this sucker.
Right.
Even if you're going out and you're saying, okay, I, am looking at, maybe somewhere down here where we have, some proven demand. If I could sell some puts at 330, 335, somewhere around that area, that would be a great place to buy Tesla. Somebody might even say, well, even this gap fill, if I could buy Tesla for 410, that would be a great value.
Mm-hmm. So
someone might look at this and say, let's go ahead and sell some puts. Now, the puts at 410, let me give you an idea here. Let's let this load this option chain.
I think while it's loading up, if you could sing Eddie Money, 2 Tickets to Paradise, waiting so long for us while the data loads. I don't know if is that a Thinkorswim thing, because I always do that with TradeStation too.
I don't know. It's taken for a minute. Today, I haven't restarted my actual computer in about a week and a half, so I think it's time.
Maybe you need to watch our computer show we did a couple days ago.
Oh, we did a computer show.
I did.
Awesome.
Well, a bunch of people asked me about it. And hey, it's a business equipment, so why not talk about it?
Exactly. Either way. So let's pretend here that we're selling some, let's say, 410 puts. Gosh, this is really not working the way that I expected.
You kind of look like a third grader right now. I like that.
Little app. I feel like a third grader.
Have you been finger painting today, Corey?
I'm just going to use this because this drawing pad is much better. How's that? Is that better? And it's going to actually work. So Tesla, sideways, 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 starting to pop up a little bit. Here's our area where we might be a willing buyer, and let's call that 410. So naturally, you might think, I'm going to sell some 410 puts. Now, I have no idea what those are paying today because I can't pull an option chain up fast enough.
Hold on. You have a co-pilot in this. See, right now it's like one of those rally races. You're driving and you're just swerving all over the place. I will see if I can bring up my option chain here and give you real-time option quotes. So what are we looking at?
410 put. Give me something that expires in 9 days.
On Tesla, right?
Yeah, why not?
All right, so let's go. I'm waiting on data. Waiting so long. Okay, so here's November 27th. What did you say, 410?
Yeah.
Oh, that's a lot of strikes. Let's go all.
Tesla has a lot.
410. You're looking at puts going for $1.30.
$1.30. All right, which is not an amazing credit.
No.
Give me the 1 month. Give me the Decembers.
All right, let me go back up here since I added all strikes a little bit.
Because I'd be willing to go out to December on something like this. I wouldn't be willing to go too much further, but
Yeah, well, you want the monthly, so December 18th?
yeah.
Okay, so 29 days out is the 18th, and we'll go to the 410s. Holy cow, there's a lot of strikes out there. We're going to looking at 985.
$9.85. Now
Wow.
That's a lot better, isn't it?
That's a lot better. I'll take that.
So that's $9.85 a share times 100 shares. So basically, when we write this option, we're going to receive $985 for every $41,000 the broker ties up,
Yep.
right?
Yep.
That's a cash secured put. Now, I think that's probably a reasonable rate of return. It's what, a little over 2%, if my math doesn't fail me, which I suck at math. $400 would be 1%, right?
Sure.
So $800 would be 2%, so it's a little over 2%.
I'll bring up a calculator just to get the number right. 4,100. Oops. I like calculators. 985 divided by 41,000. You're looking at 2.4%.
2.4%. So close, right? Which is not terrible.
No, it's good. I mean,
Now,
for a month, that's a good.
Yeah. Now, can you tell me, while you have that option chain up, how much the 405 puts are trading for at the mid price?
405. I'm reading you the bid price on that 985, by the way, because it's a huge spread. You're looking at the 405s. You got 790 bid, 940 ask. So you could go 810 for the mid.
Let's go with 810.
Actually, sorry, make that 840 mid.
840.
Yeah.
Okay, 840 it is. Right. So
Yep.
At least we now know what this leg, the 405s, are going to cost. Now, why am I even looking at the 405s? Because if I have $41,000 tied up in this position to sell a cash secured put, even if you were doing this in a margin account and this was a naked put and you had authority to do that, most brokers are going to tie up 25% of 41 grand, which is still quite a bit of cash to receive $985. Now, that's a better return, but what's the risk? The risk is Tesla's not happy up here in the $485, $500 range, and Tesla's much happier down here at $385. That would be a bad situation for anybody who owns the stock at 410.
Right.
Because and Tesla could be a lot lower.
Sure.
And so the margin requirements are big. The risk of the stock being below 410, while it may not be big, we know it can happen, and we know that there's news-driven events around stocks like this. So what I prefer to do is go out and say, what is the very next strike price in the chain? About $5 away. I don't like to go too far away from my normal credit spreads. But what I'm doing here is I'm selling the put at 410, which obligates me to buy at 410. But then when buying my own puts for $8.40, I'm taking $8.40 of the $985, and I'm actually buying this insurance. Now, what does that insure me from? Well, these 405 puts say I can sell the stock right back to the market at 405. So we know the worst case scenario is if I have to buy the stock for 410 and I can sell it for 405 because the stock is at 385, the most that we could lose is
$500. Yeah.
$500.
Yep.
That is the absolute worst case scenario, even if Tesla finds itself at zero. So that being said, the worst case scenario being $500, because both of these options expire at the same time, the broker is only going to tie up $500 in this case. In this trade, he's only going to tie up $500 of your money. In the cash secured version, he's tying up $41,000.
Right.
Massive difference, right? People talk about, well, I only have a $5,000 account. I can't trade stocks like Tesla. Yes, you can. If you learn option spread trading, you can trade literally Amazon, which
Right.
is you can trade the biggest, most expensive stocks in the world, because the difference between your long and your short option is going to be your risk, and the broker ties up only the amount that's at risk. So massive difference in terms of how much money is tied up. Now, here's another massive difference. In the cash secured put, you're getting to keep all $985 when you sell that option. You collect that, that's yours if those options expire worthless.
Right.
But if I take $8.40 of it and I buy a protective put, I don't make $985 anymore. I only make, what is that,
$45.
$45?
Yep.
$145, right? So someone says, well, I would rather sell it cash secured because I'll make more money. Okay. But look how much you have to tie up to do that, which results in a 2.4% return. Now, I would agree they make more money when you're dealing in 100 share increments. 100 shares of the stock on the covered put, 100 shares when you're talking about the bull put spread. But look at the return difference, right? Here's where I want you to get your calculator out again, Merlin.
Yep, 29%, I believe.
Is that 29%? So if you make $145 on a $500 investment, would you say that was?
29%.
29% return for the same 30 days because your money's invested is not so high, okay? And you say, well, yeah, but I'd still rather the $985. Well, when we get deeper into, and I don't need to go unless you want me to, unless we have time to, go into exactly how much risk we're taking if the price does fall. See, in both cases, you can say if the price falls to 410, close my puts, and you'll lose some money, but you won't lose massive amounts.
Right.
In the spread trade, because you have a protective put, you're losing on the 410s, but you're profiting on the 405s. So your net risk is very, very low, even if you get stopped out of this trade, which then allows you to position size and sell multiple contracts of the spread. And I'll say 9 times out of 10, just because I don't like committing to 10 times out of 10, but 9 times out of 10, you'll actually be able to say, for the same risk, being stopped out below my short strike, if I change my mind on Tesla, if I don't want to own the stock at 410, if I stop out of my cash secured puts, or if I stop out of my bull put spread over here on the left, we can equal the risk, right? So the risk would be the same. You'll be able to trade 8 to 10 times as many contracts over here, which means you'll actually make more money on the spread trade because the risk per contract is lower.
Right.
And so, so people are so opposed to spending money, but we've all heard the term before, you got to spend money to make more money, and spread trades will always let you position size higher and make more money and make a higher rate of return and not have catastrophic risk in that position.
Right.
So brokers prefer this. I prefer this.
I like it. I mean, I like the simplified art drawings too. I mean, it's pretty clear there. I mean, the only issue is, if you were trying to get, you're looking at, a 2.4% rate of return on $41,000, and you're going, well, I made more money because I made almost $1,000. On the left side, you're saying, well, yeah, you only made $145, but you put $500 at risk. Well, if you want to make that $1,000, you just basically add 7 contracts, and now you're looking at the same thing for a fraction of the money invested.
Yeah, and then that becomes a $3,500 investment, not a $41,000 investment.
Right.
Which is a massive difference. And this is especially critical on the spread trades for anybody who has a limited account size.
Yeah.
Extremely critical. But I don't care if you have, I've got a guy that I'm helping right now. He's got about a $4 million account.
Wow.
And we still do spread trades in that account because the return is better and you can make more money.
Right, but he's gonna be buying like 1,000 contracts at a time.
It's well up there.
Yeah.
So with that size of an account, you're limited to what instruments you can trade because open interest gets kind of like you can control some of the markets that you're trading with that kind of money.
Yeah.
In options. So.
Very cool. Very informative. You guys are certainly, and I agree. Big Eb says return on investment percentage, big thumbs up. But yeah, and Tom as well, who's not very vocal today, but he's usually giving me a hard time because I tend to be, in certain trades, I'm a swing for the fence kind of guy. Without a doubt, there are times where I'm going, I'm all in, I'm Barry Bonds, juice my arm with some steroids, and let me see if I can knock it out of the park. But that's in specific accounts. I know. Not making it to the Hall of Fame, Mr. Bonds. I don't know. It's funny when you see Barry Bonds and he played for the Pittsburgh Pirates, he looks like me. Then you see him when he played for the San Francisco Giants, and he just looks like Hulk Hogan. It's ridiculous. No juicing there. None at all.
No.
Raj asks, Corey, what are the key things that you're looking at for spreads? I know that we've covered some of that, and certainly that middle range area in that implied volatility graph that you mentioned is key, but what are some of the other things you might be looking for with regards to spread trades?
So, I obviously have a very strict set of rules that I would apply to a credit spread, and I have a strict set of rules that I would apply to a debit spread. So to really unpack that question, you have to look at what type of spread is it. See, a credit spread for me is more of a non-directional type trade. I'm not so much worried about what my delta position is, meaning how much am I going to make if the stock moves. I'm just saying, am I selling options in an area that I do not think price will go over the next 30 days? And that was the motivation behind Tesla at 410. You know, I don't think Tesla is going to be at 4. I mean, really got to go down here to probably these 390s. So I would look at what kind of credit am I getting on a credit spread? What kind of credit am I getting relative to the risk? And so I always look for, and you can write this down if you guys want, 15% return on the spread, at least, right? And so I'm always looking for around 30 days or less. So if I can generate 15% return on risk on a single trade, and that's just to build the trade and execute it and get into it, doesn't mean I'm going to actually win on that trade, because you do lose on some. But if I can get 15% return on risk, I know that my risk-reward relationship is actually in a really good spot for a credit spread. And that's my concern, is selling options that are outside of areas of supply and demand, support and resistance, wherever you choose to use for your analysis process. This way I have at least something between current price and the options that I'm selling to actually help keep the stock away from my short option, right? And so that's critical for me. For a debit spread, I use debit spreads, which are called bull call spreads and bear put spreads. Those are debit spreads where you have to pay money to get in. Those are very directional trades for me, right? So if I were looking at a directional trade like Walgreens, what is the symbol, WBA?
WBA, Walgreens Boots Alliance.
Boots Alliance. I don't understand the Boots Alliance thing.
Because there used to be in the UK, it was basically Walgreens in the UK was called Boots. It was the exact same store, but a different owner. They bought them and merged the two, so it's Walgreens Boots Alliance.
Boots and cats and boots and cats and boots.
That's a great one, by the way. In case anybody has not seen that, type in Boots and Cats house song on YouTube. You'll be very entertained.
Love it. So Walgreens, I actually have a very directional bias on Walgreens. I think it's going to find this demand at this area where we had a lot of resistance in the past, yet it broke through. I think we have a strong chance of finding some around 37.66. So when it comes to a long position, you know, obviously you could buy the stock if you wanted to, but if I was going to go out and buy a call option on this, I'd just buy an at-the-money call for $375. Now, the at-the-money call is going to carry a 54 delta. It's losing, you know, $1 a day in theta, and it has exposure of about 950 per point in volatility. That's what these numbers are telling us right here in the middle, right? Can you guys see those, or is that font size small?
It's a little tiny, but it's fine. They can make the screen big. I mean,
it's a little baby font. I like baby fonts.
They're so cute.
Cute. But check this out. If I go look and feel and I make it a larger font, there we go. That should actually help you. Who those numbers are a little small. Yeah. So that should help a little bit.
That does.
So this is a directional trade. The problem that I have with just buying a call sometimes, actually every time, doesn't mean stop me from doing it, but the problem I have with just buying a call option is you have negative theta. So every day you're losing money just based on time. So if I'm right on Walgreens, quickly a long call is great. But if I'm right on Walgreens, eventually I might not make a lot of money. In fact, I probably won't make a lot of money because time decay would have erased the profit that I made on price movement, right?
Right.
So if I think it might take a little while to actually get to my target, then I'll simply look at the difference between just buying the 3750 calls and, say, selling the 4250 calls. Now, what does that do? Well, it reduces the overall delta. So I went from 54 delta down to 21. Now, delta is how sensitive you are to the price of the stock moving. So this is critical for someone who can't take a lot of risk in their account because they have a small amount of money. You reduce your delta exposure, you reduce your risk reward to a less meaningful amount, and this is extremely critical during your practice time, during your learning curve.
Absolutely.
So you're not risking a whole bunch of money. Time decay went down to almost nothing, Merlin. Look at this.
Yeah, great.
Long call was losing $1 a day, roughly. A call spread with the same outlook has almost no theta, 7 cents a day. It's nothing, right? Barely an inconvenience. And the volatility exposure, which is very critical, went from $9.50 per point, and what that refers to is on this graph down here, if volatility falls or rises by 1 percentage point, then this trade makes or loses almost $10 per point.
Okay.
But if I use the spread trade, it reduces it to almost nothing. So what I like about the spread is it allows us to reduce the exposure to time decay and vega and primarily focus on directional bias. Therefore, I don't care how long it takes for me to get to my target, right, or get stopped out. Theta is almost not even an issue at this point. Whereas with a single long call position or a long put position, if we were bearish, time decay is a real concern.
Sure, absolutely.
And, you have to be right, and you have to be right quickly.
And one of the things, since you have this chain up here, I think it might be worth pointing out. When you enter this, you're doing it as one order, right? You send that vertical order, it's going out as both of those at the same time, and therefore the margin's calculated appropriately. Because if you were to do that to sell that call by itself, now you're tying up a lot more capital.
Yeah, if you're trying to sell a call by itself independently, it's going to tie up roughly 25% of the value of that call. So that's a $42,000 call.
Right. So
for that call alone, the broker's tying up 25% of that 4,200, not 42,000, 4,200.
Right. That's why I was pointing it out, because I think some people think that you could leg in and say, "Oh, I'll just do the call first." Well, all of a sudden, if you thought you had $1,000 in your account, well, you're not gonna be able to do it because it's not enough capital.
Right. And so when you enter it at the same time, it says, "Oh, your cost is $198 a contract." Then that's all they're going to require is $198 to trade this almost $40 stock.
Nice.
It is nice. It's really nice.
Two things. Jorge says, wow, options is complicated. It's like learning another language. Well, guys, the stuff that we're talking about today, I would say would be like a level 2 of complexity. Start off with learning the basics. Level 1, just understand puts and calls, buying and selling. And then as you start to compile them together, especially the way Corey's been drawing things out here, it really was clear helping explain that one specific spread trade. Then it actually doesn't become that challenging. I mean, I remember the first time I was trying to speak Italian was an absolute mess. And then now I speak almost fluent Italian. But start with the basics and work your way up. For those that want to know, Corey is not with OTA anymore. He is with Traders Army. He's working out there with Chuck Fulkerson and a few others, which we can talk about that as well. Actually, while we're on that topic, Corey, you might want to you can come back to your video here. We want to see your charming face.
Charming.
Is it every day? I see that you guys are posting that Chuck's doing a market commentary every day, which for those that don't know, it's a lot of freaking work to go. Just doing the show for an hour a day is tough, but he's doing, I believe, every day, right?
Every day he does what we call the daily market commentary, and you can get it. I mean, if anybody wants to go to Traders Army, and I'm not for no other reason going to promote a whole bunch of Traders Army stuff other than you asked about.
You should. It's your business, man. You got to make a living. I've got your website up right now. So. Oh, you do? Oh, yeah. Great. So if someone goes under the Learn menu, the very first one is Daily Market Commentary. It takes you right to our YouTube page, and Chuck Fulkerson does a roughly 30 minutes live every morning except for Thursday. The reason we don't do it on Thursday is because we actually have a live trading session that we do within the community for our Traders Army Pro members. Nice. So we actually do 4 trading rooms a week, and Thursday morning, cuts into that daily market commentary on YouTube time. So, but every other morning he does a daily market commentary live. Excellent. People come in, they ask questions, interact. They can, follow along with some of the trades, and then our members who are in the community, after we log off of YouTube every morning, the members in the community get trade updates every day. So if we're filling trades, managing risk, moving stops, taking profits, whatever we're doing, then we'll send out email updates, and it's updated on the website for members to see on a real-time basis. Well, I know that most people love free stuff. Free stuff is great. So for those that are looking out there for free, I've known Chuck for many years, does a lot of great market commentary. So I'd encourage you to check that one out. The price is right, free. As you're there, you can check out that Traders Army website as well, which I'll bring up full screen for you guys. You guys have seen it before. You've heard Corey on the program before. And every now and again they do like a summit where they bring together a whole bunch of different traders to talk about different topics, and I would encourage you guys to check that one out. It was so funny because I had Ryan Watkins on the program the other day, who's now with Stockability, and he's like, we have a Black Friday sale. Do you get any Black Friday sales going on? Medic Mandown wants to know. We always do. We always do. We haven't nailed it down just yet, but we do. We always do. We will. We haven't nailed down exactly what it's going to be. What we always make it super worth it. So nice. Be on the lookout. If you're at Traders Army and you like free stuff, we send out some free content here and there. If you're on the mailing list, so if you like a bunch of free stuff, then get on the mailing list and we'll send you some stuff. And that's where the Black Friday deals will show up. And I'll probably put a banner or something like that up on the website somewhere when we launch it. But cool. Yeah, you've got. All right. So actually, as far as signing, okay, there you go. There's a, so you can start watching the webinars, join. Okay. Got a good stuff there.
There's a whole bunch of free stuff on the website. You don't have to pay anything for a whole bunch of stuff, but you might need to, for some of it, you'll need to be a free member. So
sure.
It's easy.
All right. Well, cool, man. Well, I thanks for coming on and giving us some ideas as to the different strategies out there. It was kind of eye-opening to do the spread piece because, you're right. I'm getting a 3-4% rate of return for, a few days or weeks. But if I could do spreads, I'd probably increase that rate of return and make it much better for myself. So if the viewers didn't get anything out of it today, I got something out of it today.
Yes, I love it. I love it. I love it. I love. You know what? When we draw that stuff out, like in my intensives and in my classes, those who, and there might even be some people watching right now that've actually taken an options class of mine. You know that I like to draw everything by hand, and I like to get the students to draw everything by hand as well. Because when you draw it, you put pen to paper, and you're not just relying on a tool to do the calculating for you. You really start to understand really intimately what's going on with the options, and then it becomes just your whole world opens up when you're that intimate with how option spreads work. Mm-hmm. And there should never ever be a situation where I hear, I blew up my account trading options. That shouldn't even happen ever anywhere.
Right.
Number one, and spread trading really, contains the overall risk, which is really important as you're learning it.
Quick question came in as we wrap it up here. What time is that morning show? Les wants to know.
Let's see. Chuck usually pops on at 7 a.m. Central, so it's 5 a.m. where I live. Oof. But it's early. But yeah, and then 8 a.m. Yeah, so 7 Central.
Yeah, I'm just going to bed at that time, so I'll watch the reruns.
5 a.m.
No, I'm 5. I don't like 5 a.m. 5 a.m. is it's early. I finally get to sleep. So
I do not like 5 a.m. either. Chuck's taken actually in the early part of December. I've given him the ability to take. I think he's taken 5 days completely away from everything trading related to spend with his family, which is really important.
Absolutely.
And so I'll be doing the daily market commentary at 5 a.m. and I gotta say, I'm not looking forward to 5 a.m., but I'll look forward to seeing some of y'all on the daily market commentary.
Corey doing my daily market commentary. Awesome. Love it.
Yep. I'll be doing it.
All right, brother. Well, thank you so much. I appreciate you coming on, as always, and giving us some insights into markets, options, whatever. We just like knowledge is key. And again, thank you so much. If I don't talk to you before then, I hope you and your family have a fantastic Thanksgiving, my friend. Always a pleasure.
Awesome, man. Always a pleasure. Appreciate you, man.
All right, take care.
Happy Thanksgiving. Talk to you guys.
You too. Bye. Guys, that was Corey Lane of Traders Army. You guys can get more information by going to tradersarmy.com. I had that page up there. What's interesting is I didn't know the YouTube page is where they were doing it. I thought it was kind of behind their firewall, but you can go to Traders Army's YouTube page as well and watch the archives of it. But Chuck does a great job. He's very passionate about what he does, as well as Corey. I think you guys can see that kind of come through in his teaching style. Okay. Larry says, why did the MES tank today? Why did the MES? Why did the NQs? Why did the IWN or IOIR? Why did everything tank near the end? Look, I think a lot of what happened at the end of the market today was due to just fears about the market. All of a sudden, California got slapped with another lockdown. We could be in total lockdown here soon in California. Who knows how extreme it's going to get. I'm hearing more and more each day on how dire the numbers are for COVID. So I think what's happening is it's just a little bit of a panic sell-off, right? It's going. You remember the sell-off we had back in February when when things were shutting down? Well, not saying we get that one that's that steep, but if we go into full lockdown mode going into the holidays, yeah, I think you could see a pretty significant pullback here. And maybe today was that bull trap that Tilly was talking about in her weekend edition that she does for us when she talks about market analysis. It's that everyone thinking it's overly euphoric. We rip to all-time highs on just about every single thing. And then all of a sudden, selling comes in. And, keep your eyes open for the next couple of days. It could actually sell off pretty aggressively if there's some momentum through here. We don't really have anything major on the earnings front to support an upward move, right? Most of the big companies have already reported. You also have the retail sales numbers didn't look so good. So unless we get some stimulus right now, it would be challenging to me to point a finger at what would cause this market to continue to rally to the upside. Initially, what I thought for the past couple weeks as it has been a rotation out of the FANG stocks into those companies which might be more of a longer-term value play. Not necessarily value, but just stable, big, long-term companies who knows how it's going to transpire. But that's the reason why I think it's pessimism coming in. Also knowing that even though that these drug companies are coming out with a vaccine for COVID, it's still going to take some time for those things to come to market. And, I don't want to sound like a bitter cynic, but there's no way in hell, even if I was forced to by the government, am I going to shove a needle in my arm with some untested vaccine that hasn't even made it through lab rat testing over the past couple months, and you're going to try to get that into my arm to cure me for something that has a 1% chance of killing me? I'm sorry, I'm not taking it. So I think that there's a little reality check here, and that this COVID vaccine is going to take some time to come to market and be tested and get through loops that it needs to be to get pushed through to get to market finally, and this all ends up going away. Who knows how it will. Do I think Elon will affect the S&P 500? He already has. I certainly think Elon is going to be a factor, and I think that Elon is a brilliant... He's not as much of a manipulator like a reality TV show host as Donald Trump has been politically, but certainly he knows how to use social media. He is one smart cookie. I think he'll have an influence on it. But it goes back to a discussion that was brought up from Tom, and I think Big Eb as well, talking about, do we think that these competitors coming into the marketplace are going to dent the shining aura that Tesla has? I 100% do. I actually saw another one today about some UK, transportation electric vehicle thing that's going to do an IPO for $6 billion, and here come more and more and more. You'll probably some of those will fade away, but there will be others that are going to be great projects. And when you look at somebody like General Motors or Ford or Toyota, Honda, I could very easily see them going out and saying, okay, who's looking really good right now because we don't have the technology, which they probably do, and they'll go out and just buy those companies outright. And all of a sudden you'll see a consolidation like we did with the brokerage firms back in the 90s, with the .com back in the 90s as well, and these companies will probably do very well, all at the expense of somebody like Tesla, who's been hands down the lead dog for a long, long, long time. Okay, let me go through economic calendar for tomorrow and earnings calendar just so we can get through this. Because I realize the time is a-flying out there today. Here's what we've got. For tomorrow, this is the 19th, you've got Macy's. You also have Canadian Solar reporting earnings, Workday, Weibo, Ross Stores, and Intuit. So more retailers reporting, Ross Stores, Macy's being the main ones there from the clothing side, who is, we saw on the retail sales numbers that clothing stores are taking a big hit, but some reported yesterday and did really well. Kohl's, surprisingly, just ripping to the upside. I mean, earnings-wise. Here's what we have cooking on the economic calendar this is today's earnings. NVIDIA, by the way, did report after hours. Huge spike up, followed by a massive slice to the downside. But you notice everybody really beating earnings out there on today's earnings announcement, which obviously looks pretty positive, but I think the overall looming economic shutdown might be raining on that parade a little bit. Here's what is happening. Where did the other one go? There it is. This is the one I meant to show you. For tomorrow's economic calendar, fully fed manufacturing index, unemployment claims for the U.S., which is expected to continue to drop, although not as sharply as it has been over the past few weeks. We also have existing home sales, which are expected to drop slightly. Natural gas storage as well for the U.S. Germany has their producer price index, British pound of the retail sales, and that pretty much is it for the major stuff. Although, let me take that back, because Brendan's here with us today. We have, for Canada, they have their ADP non-farm employment change number coming out at 5:30 in the morning tomorrow as well. So we've got to give some shout out to that one. That's usually a major market mover out there. Cool. That's going to do it for the bulk of the content. Big Eb says, although I think Tesla's success goes way beyond EV, yes. But remember, if you're buying Tesla, you're not buying Hyperloop. If you buy Tesla, you're not buying SpaceX. If you buy Tesla, you're not buying any of those other companies, right? You're buying Tesla. Now, if it's, and I agree with you, Big Eb, if we can get Tesla, I have to say we, like I'm a part of the process or something, if Tesla ends up getting a lot of traction with its solar and battery power, yeah, that separates them from the competition, hands down, without a doubt. But as far as the vehicle space goes, you got a ton of competition coming in here. It's becoming the fad of 2020 now. Is let's just start an electric car company. That seems to be what everyone's doing. All right, cool. I won't read that one on air, Brendan. I get in trouble for people saying I curse too much. He says he just ignores the economic news. The Canadian forecast is snowy from the snowy north. All right, yeah. All right, guys, that's going to do it for me for today. Hope you liked the show with Corey Lane. I thought it was interesting, the discussion on options, especially when he looked at looking at implied volatility. A very simple way to break it down as to, should I be looking to buy, should I be looking to sell, or just maybe do spread trades when things aren't as volatile and kind of chopping back and forth. Very similar to what we would do if we were trading equities or futures or Forex, which is saying, if it's up at supply, yeah, I'm thinking of selling. If it's down near demand, I'm thinking of buying. Of course, we have to have stop losses in place in case we are wrong in those scenarios, but at least it was a very clear-cut way to look at the strategies for options and then explain that options piece, which I know was over some people's heads, but I like that one. I thought it was a pretty good example. That will do it for me for today. If you like Corey Lane, you can go to his website, which is going to be Traders Army. He's him and Chuck Fulkerson doing a good job over there. They got a bunch of other people behind the scenes working on content. He does a free market commentary, which if you go to Learn Daily Market Commentary, right on the front page of Traders Army, that takes you to our YouTube page where you can see Chuck every morning. He said 5:30 Pacific time. I assure you, you probably won't see me in that session. Now for tomorrow. And Big Eb says, you guys and gals, hit the like button. Yeah, that would help me out. I'd appreciate if you hit that like button. Like buttons, comments. Of course, you can always send in your comments and questions at TraderMerlin@gmail.com or go to TraderMerlin.com is easy as well. Now, tomorrow is going to be a little bit different, right? We're not diving into the minutia of actual executions and trades. Tomorrow, it's big picture. I'm going to bring on Bill Addis again. We're going to talk about the bond markets, which we've seen those yields rise sharply, significantly from when Bill was on the program last time, and he called it out. He said there was going to be a steepening, is what he called it, with regards to the yields on the longer term maturities. And we've seen that happen. That 10-year is at a pretty vicious run over the past month and a half. That may continue. So Bill Addis will be our guest tomorrow talking about bonds, interest rate products, yields, and things like that, and maybe what the current political gridlock situation in the White House might do to those markets. So that'll do it for today. Hopefully you guys will enjoy the show tomorrow. So join us same time, same bat channel. I'll see you tomorrow. Take care.